everyone, a very warm welcome to everyone here. I hope you all are fine and doing well. A very good evening to everyone. So, here I am hoping that everything is visible from my end. So, today we are going to start the chapter Risk in the Foreign Trade, Role of the ECGC. What are the risks available in the foreign trade and what is the role of ECGC in these types of risk, and what is the role of ECGC basically at the international level. Okay, so we are going to cover this today, the important things in this chapter. Short chapter, conceptual chapter is this, so we have to learn all the concepts here. So first we are starting from the international trade. As we know that, what is the concept of international trade here? International trade is basically like when we do, just a minute. International trade means there is a type of trade when different countries are doing the buying and selling at the international level, and due to this international level there are lots of risks are here. For the buyers there are lots of risk, there for the sellers there is having a lots of risk, and also with the shipping there is lots of risk. Now these types of risk need to be carefully managed to reduce their negative impact, and also the increases the chance of making profit. Basically here risk management is compulsory. Risk management is very important to manage these types of risk. If there is any situation that creates the problem for the banks or the companies, so this risk management helps in managing these type of things, and it also increases the chances of making a profit, and so the businesses can achieve the goals whatever they want to achieve in their organization or in their banks. International trade, basically it has become possible due to the financing. How we can say banks are connected to this international trading? Like banks are not interested, or not the type of business in banks is uh, like to buying and selling, related to buying and selling. So basically banks helps those businesses who are doing this international trade. By Because of financing they can pursue their all the activities which are related to the international trade, and if there any type of credit risk is there, so lots of countries take the initiative and established a export credit guarantee corporation. In short we can say these are the ECGCs. Why these organizations are formed, why this corporation is formed, established? Just to protect both export financing institutions and from the exporters themselves. Means to protect the exporters so they can do the business, they can do the international business very freely and runs this operation smoothly. And in the India, the role of ECGC is very important for all the exporters who are doing their business at the international level without any type of misunderstanding or any type of thing. Okay, they can run freely, they can do the things freely. That's why in international trading the role of banks are very important. Clear? So that is the first thing. Now next thing is there, what we can say, what is the definition of risk? Why we say risk is like, we know that there is a loss, there is anything that comes with the loss. Risk is a type of situation which causes the situation of negative outcome. the situation of negative outcome. And what is that negative outcome for the businesses? Only loss. The business does not want that they face the situation of loss. They just want profit for the surviving in the market. So risk is that uncertain event that could lead to the financial loss or reduced earnings. And if there is any activity that might bring a profit or result in a loss, is considered here as a risky proportion, because outcome is here uncertain. We don't know what is the outcome. And if we compare our daily life, in our daily life, risk is present in every situation. Like there is a weather update, tomorrow is rain. So what we do? We will took raincoats, we will took the umbrellas. So there is also risk in living. Why? Any person can suffer from any type of disease, even they have the risk of death. So risk is just about same, just we are having in our daily life. There is many risk available in our daily life activities. Like in business, risk is about whether a company will make a profit or loss, depending on how well they are managing these things. In simple terms, risk is the uncertainty. We don't know about the outcomes of an activity. That is called, we can say, is the example of risk here. Fine. Now let's discuss some common types of risk. Just a minute. Let's discuss some of the common types of risk. What are the common types of risk, we can say? Okay, so common types of risk we can say here, first risk is here buyer risk. Buyer is always in the situation that he or she will face the risk, because if seller sends the good, seller faces risk to the relator. Seller is sending the goods, okay, and buyer is not able to accept these goods. Seller face the risk. That why seller face the risk? Because he is unable, like ship. I am giving you the example. There are two persons, and in this you will able to learn what is buyer risk and what is the seller risk. They are having a business relation. Why? Because the seller sends a product, sells a product to the buyer. Buyer say that I didn't like the product and returns it, that I am not able to give you the payment for this product. Now seller faces the risk. Why? He or she face the loss for in the first situation. First they seller face the risk, and buyer is also facing the risk, because quality is not that much expected. So there also the credit risk is buyer is unable to pay. This is the buyer risk. Basically name is buyer risk. That does not mean this is the risk related to the buyer. This risk is related to the seller. In that condition, like we can take the example of e-commerce websites. Like we order something from Amazon. Now Amazon seller, who is the registered seller of Amazon, packs all the goods and sends to the buyer, and buyer say I am not available, I am not able to give you the money for this product, cancelled it. So the Amazon seller faces the shipping charges. That is the problem of seller. But now companies take the actions for this. What actions? They start taking the cancellation fee. That fee, due to this fee, they can able to afford the expenses of shipping. Okay. Seller risk means when the buyer faces regarding the seller. Risk regarding the seller. Like seller is not honest. Seller is not sending the goods after receiving the payments. Shipping the poor quality goods and delaying the shipments. This type of things leads to the cancelled order, further delays, even the penalties. Buyer and seller become more familiar with each other over time, and these type of due to this thing reduces the risk. Okay, and recently I told you the example. I ordered a thing. What type of risk I faced personally? I am telling you the example. I ordered one dress from a app that is Misho. Okay, there is a app Misho. Now what happened? Uh, in our society, there are so many delivery boys are coming everyday basis. Now what happened? Someone ordered from the society, ordered the one dress and puts my number, and then after 2 days he I don't know, he or she, I just got the message. So that buyer request that I don't want that dress, take it away. But it means written request is there. Now that Flipkart guy, that person, that buyer who rejects the dress, that buyer is purchasing that is purchased that dress from the Flipkart. Now the Flipkart delivery boy having my number, that person comes and tell that you are putting a request of returning, so kindly give the dress. And I already ordered a dress, I don't like that dress, I also raised a request of return. I think that this person is related to the Misho. I returned it. From that day and now today, there is about 3 to 4 months old talk is this incident is this. No refund. App is saying, we Misho is saying, we need dress, we will get you the refund, and that delivery boy is not responding at all. I don't know what happened, but this is the condition of risk, and I face the risk in this situation. Okay, so now shipping risk is there. What is the meaning of shipping risk? Shipping risk is like when the risk involves problems caused by the intermediaries, means middlemans, middle institutions, middle authorities between the seller and buyer. And this type of risk include delayed payments, mishandling of goods, loss or theft of goods, goods delivered to the wrong location, goods damaged due to the transit. So there are some external factors are also there. Some strikes are there, attacks are there, container shortages. These things are also able to cause the delays. And because of this, risk are out of the buyer and seller control. Countries sometimes treat shipping and related services are essential to ensure the continuity of the international trade. That is also playing an important role. Then one more risk. There are some categories of the risk in the international trade. What are these categories? These are the categories that affect the buyers and sellers at different stages, and these types of risk can be categorized as the credit risk. Credit risk occurs when one party is unable to pay the money. That situation causes the credit risk. If the buyer faces some financial difficulties, defaults, goes bankrupt, they may not able to pay for the goods, leaving the seller at risk or not receiving the payment. Legal risk, when there is a legal lawsuit is there, law and regulation in the buyer and the seller country. These type of risk is also creates the problem. You can take the example of TikTok here, and there is also a app which is called Club Factory. In this app there is lots of cheap stuff is available, so many people are attracted to this app. But due to the government regulation, now these two apps are banned, and some other uh, apps are banned in our country. So these type of things are also creating issues for the businesses, for those businesses who are running at the international level. Then the exchange risk. This is risk which is related to the changes in the currency values. Both here exporters and the importers, they are faces the exchange risk when the transactions are invoiced in a currency other than their own. If the currency in which the payment is made becomes weaker compared to the home currency, then the exporter can lose the money when they receive the payment. Similarly, if the home country strengthen too much compared to the competitor currency, the exporter goods become more expensive, which causes buyers to shift their orders to competitors from the other countries. So these types of risk understanding is very crucial for the businesses who are engaged in the international trade, so they can manage and they can minimize the potential losses. Fine. So there is also a risk which is a country risk. Some financial losses due to the events in a specific country, changes, laws, political instability, that makes a problem for the profitability of a business. That type of businesses, we can say, are related to the country risk, in which the policies of the government plays an important role in reducing the profitability of a business, or make it very difficult to recover the trade credit. These are the things, these are the factors that creates the problem for the risk at the international level. Okay. And RBI is the apex bank. Now RBI is saying, okay, I am setting some guidelines, how can you deal with the country risk, and banks are now adhered to follow these guidelines. And if banks have not their own country risk system, they can use the ratings which is provided by the ECGC. ECGC rate the countries into the 7 categories. What are these 7 categories? These are the 7 categories. In this, you can see significant risk, low risk, moderately low risk, moderate risk, moderately high risk, very high risk. ECGC classified 207 countries in the open cover category, 27 countries in the restricted cover, 10 countries in the restricted cover group 2, that is related to the high risk. These are the ECGC groups, countries which are classified into the 7 risk categories. Fine. Okay. Now let's learn about the ECGC. What is the meaning of ECGC here? If I talk about the ECGC, what is the meaning of ECGC? See, ECGC is a type of a government-backed organization which is here just to help the exporters. Whatever the exporter face the situation, ECGC help them. They provide insurance, they provide how to improve the credit worthiness of an exporter and make it easier for them so they can access the loans and better financing options from the banks. Some of the key objectives: they promote the globalization, they assist the Indian exporters how they can manage the credit risk, they protect against the unexpected losses, they help the exporters to secure the bank financing, they improve the performance, they develop the expertise and the innovation, they educate and promote the services. So we can say ECGC are there to help the exporters at the international level so they can do their businesses very smoothly. Some of the main activities of the ECGC is like insurance is there for the exporters. There is a credit insurance for the banks and the financial institutions. There is a export finance activities services for the MSMEs. There is a credit risk insurance for the exporters. There is insurance to the banks for export the financing. These are the activities of the ECGC. Some of the insurance products you can just read it, available for the banks. Okay, then what are the risks that are not covered by any type of standard policy? There are some commercial disputes. Buyers and seller disagreements are not covered under these standard policies. There are some inherent good risk related to the nature of the goods being exported. This is not acceptable at all. Some of the import or exchange authorization failure is there, like if buyer fails to get necessary approval for the import or exchange in their country. Some of the export agents or the bank issues loss is there, they are not acceptable under this. If there is any exchange rate fluctuation, that is also not acceptable. Clear? What is the meaning of this small export policy? This is a very special type of insurance policy which is issued by the ECGC to help the small exporters. Now small exporters, you know what, whose turnover is not more than 50 lakhs in the next 12 months. In this, commercial risk is included, politic risk is included. Okay, politic risk, commercial risk related to the buyer insolvency, failure to pay, failure to accept goods. Political risk are totally related to the government. Then some specific shipment short term policies are there, which are designed obviously to protect the exporters. And here is also different types of policies are there. Specific shipment policy, specific shipment political risk policy, specific shipment related to the insolvency and the political risk. Some of the things that is not covered by the policies, that is the basically agreement. Okay, that is basically the agreement, disagreement, whatever the risk related to the nature of the goods, buyer not getting the necessary approval, policies do not cover this. Loss or damage, fluctuations and the default or any issues with the agents or collecting banks. Exporter failing to meet the terms of contract is also not covered by the policies. Some of the export specific buyer policy that is designed to protect the Indian exporters. Everything is there for the Indian exporters. In this, three types of policies are there: buyer wise political risk, buyer wise insolvency. If failure of the LC bank and political risk, then this type of policy helps in these types of situations. Then some buyer exposure policy, that is the another version of the policy for the large exporters. In this, it allows exporters to cover their risk with a particular buyer which is based on the exporter expected exposures. And a separate buyer exposure policy is issued for each buyer, which covers all the shipment for the buyer at least for the 12 months. Export turnover policy, special version of the standard policy for the large exporters who pay a premium of at least 10 lakh per year. So they are able enough to pay the premiums. This policy offers the several type of benefits: a discount on the premium, a very simplified process is this, a higher credit limit is there. Export turnover policy lasts for at least 1 year and not then follows the same policy. There is one more thing, that is sites. Sites means IT enabled services. That is basically designed for those contracts where services are provided only to a single customer over a specific period, week, month or quarter. Policy is only valid for 12 months, covers commercial risk, political risk and the risk which are related to the LC. Packing credit insurance is a type of loan which is given to the exporter so they can manufacture, they can run their activities related to the business very smoothly. Again, validity is 1 year. If exporter fail, then the uh, claim is there made. Post shipment export credit policies basically protect the banks or financial institution that are basically doing dealing in the foreign exchange. And it is also having the basically covers all the post shipment export credits, and 12 months period is there. Okay, then there is a maturity factoring. What is the meaning of maturity factoring? It is a service which is offered by the ECGC to the exporters. It helps in financing and collecting payments for the exports, as well as providing the credit protection. Why factoring is useful? Export can open made an on open account. Good track record is important. Continuous business relationship is important. Sale does not involve any type of counter trade. Then some of the key points about the ECGC policies. There is a risk sharing. ECGC covers 90 to 90% 5% of the export value or financed amount. There is a regulation by the IRDA. ECGC policy are governed by the Insurance Regulatory and the Development Authority. There is some monthly declaration. Exporters who are having the policies cover all their exports that need a monthly declaration. So sometimes bank covers the post shipment finance and also send monthly declaration by the ECGC. Now the claim uh, time for claim filed is 12 months. Claim directly paid to the bank. Banks can claim the amount. Exporters still, if they need to recover, any future recoveries must be shared with the ECGC. So the guidelines is very important to follow all the guidelines. ECGC issues some guidelines, so bank have to follow these guidelines. So that is it. In this we covered all the important things in this chapter, all the important terms. So I hope that it gives you the things, it gives you the things that in the chapter, in this chapter. And we can say important chapter. Module A is whole important. So that is it from my side. I hope it helps you. If you have any issue, you can just ask in the comment section. I will address you, and you can join the group also, and link is in the description box. So thank you so much for attending this class. I hope you all understood these things. So we will meet in our next chapter. Till then, take care everyone. Have a good day all. Thank you so much.